Creating your ideal investment portfolio, what to consider, and asset allocation. A good investment portfolio is one that meets your needs in terms of return, volatility, and time horizon. Tools like spreadsheets can measure these factors. A good investment portfolio today might not meet your needs in the future. Creating a good investment portfolio means selecting the right assets from the appropriate classes. Analyzing your investment portfolio in such a manner will help you sleep soundly. With the worksheet that you can download in the description, you can specify the amount of your investment leverage, and you can even test the effects of additional volatility. Based on historical data, you can decide if your current asset allocation works for you. Building an investment portfolio, what to consider. Whether the market's going up, going down, or going both ways, it pays to have a portfolio that you don't lose sleep over. If you handle your own investments, you need to have a plan about how you're going to allocate assets in that portfolio. Goals are your own. Your portfolio should be a reflection of those goals. Of course, we all want a nice return on our portfolio, but there are other things to take into consideration. For instance, what type of investments do you understand? You shouldn't have anything in your portfolio that you can't wrap your head around. Another thing to consider is the amount of money you have to invest. Some investment opportunities are too costly to add to your portfolio. Also, you probably shouldn't have anything in there that stresses you out. All investments will cause concern from time to time, whether it be fear of missing out, FOMO, or fear of losing it all. However, if you're consumed by the perceived risk of a particular investment, it's detrimental to your quality of life, even if that investment earns a good return. The boilerplate advice for constructing a portfolio is to make it well diversified. X% of stocks and Y% of bonds, all depending on your age. That's just advice for the average person, however. You're not average. Let's go over some ways you can determine what you're comfortable with and what you're competent at in order to create an ideal investment portfolio. Here's some things to consider when answering that question. What do you want to use the money for? Do you have a specific goal in mind, or are you just trying to build wealth? Are you someone in their 20s or 30s with a long time horizon? Or are you in your late 50s or early 60s with a not so long horizon? What do you understand? Maybe you can analyze stocks with the best of them, but do you know how to trade options? Are you even interested in doing that? How about futures, Forex, crypto? If there's something you're interested in adding to your portfolio but don't yet understand, leave it off for now. Educate yourself first. There's going to be plenty of resources out there, some of which you might find on investsomemoney.com. How much do you want to allocate for each asset class? Once you have an idea of what type of assets you want to include in your portfolio, it's time to decide how much to invest. You can always change how much you have allocated to a particular asset class, of course, but why get off on the wrong foot? Best bet is to run it through a model. A note about volatility. Everyone thinks that volatility equals risk. Personally, I think volatility equals volatility. Risk has more to do with your chances of going bust. But between now and the time you close the position, your investments could behave in less than ideal ways. You need to decide if you can tolerate that behavior or not. Asset classes and sub-asset classes. Keep in mind that nearly every broad asset class can be niched down. Stocks can be invested in dividend-paying stocks, growth stocks, value stocks, tech stocks, and so-called bellwether stocks. Bonds can be broken down into government bonds, corporate bonds, high-yield bonds, and risk-free bonds. Mutual funds can be stock funds, bond funds, index funds, growth funds, or specialty funds. You get the point. The same thing goes for ETFs, Forex, futures, crypto, whatever you want to invest in. Each sub-asset class might behave differently, so be wary of using proxies or grouping sub-asset classes together when using the downloadable workbook. The point is to get a somewhat accurate representation of how these assets will behave together. And that's all I got for this particular video. I'm going to post a couple more on this subject, so keep an eye out for those or check out my channel when to find them. Thanks.